over here. Let's dance. Let's dance.
This channel is all about simplifying finance, and therefore it is only right I shed some light on one of the most simple and effective approaches to investing, and that is view for life, the idea of being all in on the S&P, the S&P 500. So is the S&P actually the best way for Gen Z to invest, or are there better ways to allocate our money? And so point one, the S&P is diversified. Instead of trying to guess which company will win, you're investing in the overall growth of the tech industry, and technically the global stock market itself. Because when you invest in the US, you are investing in the US economy, and by extension, a large part of the global economy itself. And this is because many of the biggest companies in the S&P don't just operate in the US, but actually generate revenue all over the planet. So when we invest in the S&P, when we invest in the US, we aren't actually betting all of our money on this one country. It may seem like we are, but we're actually not. You know, really, you're investing in the continued growth of global business, which is largely led by American companies. When the US performs well, it often pulls up the rest of the world with it. And at the same time, when the US struggles, global markets tend to feed it too. So generally, when the US is up, the world is up. And when the US is down, the world is down. The S&P 500, the view for life approach to investing, is therefore simple, diversified, and historically reliable. And so point two, the S&P also gives you that heavy exposure to tech stocks and AI, which although has high potential upside, is potentially a double-edged sword. You know, the S&P is market cap weighted, meaning that the larger the company, the higher percentage that it will have in the fund. And the index is currently highly concentrated. The top 10 companies account for about 39% of the total market value. And some see this as negative, but I'll explain my stance in a second. So right now, Nvidia is at number one with a 7.79% weighting, meaning that if you were to put $100 into the S&P, 7 to 8 of those dollars, so $7.79 would be put into Nvidia. And obviously there are a few other companies with higher weightings. So Apple at 6.82%, Microsoft at 6.1%, Amazon at 3.8%, and Alphabet, or the Google people, at 3.1%. And so the reason I was saying that this is a double-edged sword, this high concentration in tech and AI stocks, the risk is that if this AI bubble were to burst, the S&P would take a serious hit, because a huge chunk of the index's recent growth has come from companies like Nvidia and Microsoft and Apple, and a lot of that growth is built on AI hype. Investors are betting that these names will own the future entirely, but of course many believe that these stocks are already overvalued, and that's where the idea of an AI bubble actually comes from. And the thing is, this idea isn't new. We've seen it before. Well, I haven't seen it before. I wasn't really alive at the time, but back in the late 90s, the early 2000s, investors were pouring money into anything with a .com attached to it. So you might have heard of the .com crash or the .com bubble. You know, the internet was brand new, it was revolutionary, and everyone believed that it was going to change the world. And they were right, it did change the world, but they just got a bit ahead of themselves. And so eventually reality caught up. The bubble broke, stocks collapsed, and a lot of people lost a lot of money. And so the .com crash is a looming reminder, a looming warning of what could be in store for us this decade. But in my opinion, and maybe it sounds like sidestepping, but I do not see this potential AI bubble as an issue at all. You know, I'm not here to predict the future. I'm not trying to decipher the political and economic state of the world. And that is, one, because I don't actually have time for all of that, and two, more importantly, because I am young and a long-term investor. And I guess three, because I don't actually handpick and research individual stocks anyway. You know, I'm not plotting on the next big AI or oil or modern warfare stock. But regardless, I'm not actually worried that the bubble might pop. I'm not worried about a crash. And that is because I am not going to be cashing out anytime soon. You know, again, I am a long-term investor, and I'd assume that you watching, like me, also have a minimum of 20, 30, 40 years in the market. We have many decades or many years for our portfolios to ride out any potential crashes and volatility. But maybe that isn't the case for you, and that's okay also. Maybe you're approaching retirement and you're looking to cash out soon. I highly doubt retirement age people are watching my videos, but again, this is okay. You know, different investors with different mindsets, strategies, and ages will all come to different conclusions. They will have different perspectives on a given asset because of these factors. But this is why I believe that the S&P 500 and or other growth focused or aggressive ETFs, funds are such a good investment for Gen Z. And that is again because we actually have the time, we have the advantage of time in the markets. And so therefore we can mitigate a lot of the potential downside while still reaping all of the upside. We can buy the dips, we can buy the crashes and just ride out over the years and see where our money takes us. And so regarding a crash, regarding the AI bubble bursting, I have cash reserves waiting for when we see this crash. And it is at this point where I'll be one of those buying the crash. I'll be buying any dips because this is how you actually build wealth in the stock market or with any investing in any asset, period. And I am so confident in the S&P 500 being the foundation of my portfolio going forward. And that's also because of another thing. So rebalancing. Point 3, the S&P, like many other funds, rebalances itself automatically. The S&P 500 is an index fund. It is the top 500 companies, meaning that this list of 500 companies is not set in stone. And so new emerging companies can enter and companies that are falling off can exit that 500. You know, winners grow, the fund or ETFs in general often allow new winners to enter. And that is without you having to do any tinkering or fiddling. And you know, companies that are not so successful fall down the rankings, meaning that their weighting is reduced or they get cycled out of the top 500 entirely. And this is a big part of why the S&P has stayed relevant for so long, because your money is always concentrated within the strongest companies in the US. And again, this is without you having to do anything, so no fiddling around and no research in new and emerging companies. Unless you really want to, of course, unless it's a passion, unless it's a hobby of yours, then fair enough. But yeah, this is a part of why I'm so confident in the S&P going forward. You know, alongside looking to the historical data, looking at the 7 to 8% annual return, the rebalancing, the diversity, strong concentration in AI and growth, the high upside, you're also getting a solid, stable foundation for an investment portfolio. And that is what the S&P provides. You know, with View, the S&P, we are invested into simplicity, diversity, and overall emotional protection, especially because a lot of us are investing into crypto or other volatile assets like that. You know, the S&P is our foundation, it is the stable majority of our investment portfolios. But coming back to the idea of a major crash or even smaller dips, we as Gen Zs should not be worried about these whatsoever. And again, I myself will be buying during these opportunities. And so linking to this, I want to share a little mindset shift that you can adopt when it comes to investing. And I'm not going to mention crypto itself as an investment in this video, but one thing that I do take from crypto investing and bring into the stock market side of things is the slightly different perspective on accumulation. So when investing in crypto, when one goes to buy, say, Bitcoin, for example, you could look at your transaction as, okay, the markets have dipped, so I'm going to buy $30 of Bitcoin. But a slight mindset shift, a slightly different angle is thinking of my transactions, my buy orders by the actual amount of Bitcoin that I'm buying. So for example, I think to myself that, okay, the market is down, so I'm going to buy 0.001 Bitcoin, or the last month I had, let's say, 0.05 Bitcoin, but this month I aim to accumulate up to 0.06 Bitcoin. So instead of looking at your portfolio by the number of dollars that it is worth at a given time, you could instead focus on how much asset you actually own. And the reason I believe that it's beneficial to sometimes think this way, to approach crypto, stocks, and investing in general in this way, is because price changes, especially in the modern day. Stocks, crypto, gold even is very volatile nowadays. So it's not as constructive to look at the number of dollars or pounds attached to your portfolio, because this number tends to fluctuate, and it fluctuates a lot. You know, crypto is volatile. And again, even with the stock market in the modern day, bro, the stock market has been very volatile recently. And especially if you're a new investor, it's very easy to get sucked into the trap of trying to time the markets and wait for the market to dip to put your money in. But again, this is not constructive. Understand that we're going to be in the game for multiple decades, quite literally multiple decades. So focus more on accumulating shares or units or ounces of gold, a percentage of a whole Bitcoin. Focus on actually buying more actual asset. Remind yourself that you are buying the asset that you believe in because of its innate value and not necessarily because of its price. And of course, you want to be cognizant of price, be aware of how the markets are doing, be aware of how much it costs roughly to buy a bit of Bitcoin, but don't let the price of assets paralyze you. Don't let the price delay you from actually investing. Do not let the prices prevent you from getting started in the first place. price, because the stock market and assets in general will only reach new higher and higher highs over time. So instead, buy high quality assets and then aim to buy more of them when there is a slight discount. But yeah, I would say to focus primarily on accumulation over trying to snipe the exact price. But yeah, that's about it from me. As for the title or whatever, I do believe that the S&P 500 is one of the best investments for Gen Z, alongside a few other assets, you know, Bitcoin, other cryptos, potentially gold or silver. But generally, as for the stock market, I do believe that the S&P or similar ETF is the best foundation that we can have as Gen Zs, or Gen Zers, however you say it.